Welcome to Tab's 2 Cents, a show for average Joe investors where we talk finance and how to achieve success.
Hi, welcome to Tab's 2 Cents, a show where we talk about finance, business, and achieving success. Today on the show, we have Doug B. Doug is an engineer by trade, but a DIY investor as well. He's been investing for over 30 years and has a wealth of financial knowledge. Welcome to the show.
Hey, thanks a lot, Joe. Nice to be here.
Awesome. So I wanted to start the show just by asking you how you started investing, what kind of strategies you developed along the way, and where you're at now.
Well, I'm one of those guys that started investing as soon as I got out of school and started working. Actually, probably even before that, right? I'd been investing in musical instruments and cars and in education while I was going to school. So when I got out of school, for me, it was just real natural to start putting money away right away. So I was reading all the books, back in the early 90s and, starting to squirrel stuff away. And, after 30 years of investing, I'm retired now. You know, time kind of gives you a bit of perspective. And, what I started off doing 30 years ago was really cool. I think it was the right thing to do. And how it ended up, I don't think I could have really anticipated 30 years ago. And I think I was very fortunate. The time in the market and the patience I had with a lot of stocks that I owned ended up paying off. And I think that's probably going to be truer for more people than not. I don't believe in the fast trading. I'm sure it can work for some people. It just isn't my strategy. I prefer to buy and hold stocks, and like Warren Buffett says, my longest holding period would be forever, ideally if I have a good stock. But it's been 30 years of learning, sharing, and growing my portfolio, and kind of figuring out how I work, right? So, dividend investing for me is one of those cores of my portfolio. It's worked out, and I'm going to keep on rolling with it.
Dividend investing is certainly one option and it's people like, and it's interesting because even guys like myself who are more or less just starting and we have a long runway ahead of us, dividend investing is still appealing in some ways because you get dividends for your hard work and research. And it's interesting. Something I saw the other day on Twitter was a guy put out a post. He said from 1980 to 2019, 75% of the S&P 500 returns would be lost without dividends. And obviously we're investing in compounding. And to me, that kind of stood out as a high number. And I thought that was an interesting fact. But I wanted to ask you, with dividend stocks, what sort of a range do you look for with stock? Because for me, it's around 4%. I kind of look at energy as a good indicator. Oil stocks are generally 4 to 5, 6%. But at a certain point, when they start getting higher, 7, 8, you start to get concerned that the stock price is lost enough that perhaps that dividend is too high. So I don't know if you had some perspective on that.
You got a couple of different things in there that I think we can touch on. One of them is kind of chasing yield, right? And I think you got to be careful chasing yield. I prefer to take a lower dividend in a stock that I think is better able to prosper in the long term. Um, you know, People make mistakes. I've made some mistakes in dividend investing. I've chased yield before, right? And when you chase yield and you get too caught up in how big the yield is, you can become blinded to something. So, you know, everyone, when they're getting into this investing world, is going to make some mistakes. Start learning from your mistakes when you get into this. Okay, you're going to make them, and you just got to kind of shake the dust off and get going. There was a stock a few years ago that was following a newsletter at the time, and we had some money in the stock, and I mean the telltale signs were there that the business was coming to a logical end. But we kept on looking at it saying, hey, you know what, we think that this is still a good investment. And it ended up not being one, right? So that company ended up going to zero. So when the market is rewarding a stock so greatly, that is a telltale sign. You're not going to fool most of the people most of the time, okay? So For my dividend investing, yes, I have some stocks that are yielding, 4, 5, 6%. I've got some that are yielding 1%. I've got some that don't yield anything yet because I'm not purely a dividend investor, right? I mean, dividends are wonderful. I agree with that number that you threw out, in that 72%. That might be a bit high. I was thinking more like 2/3 of the stock market's returns. But whatever the number is, 50%, 75%, it's a significant amount of the market returns come from dividends. And I think as an investor, to not be paying attention to that part of the market, it can cost you. Um, One of the things that I really love about dividend investing is you get rewarded to be patient. If you're constantly buying and selling your stocks, you're really not going to capitalize on the dividends and the dividend growth over time. Even if I go into a market correction, my philosophy is even if I have a market correction, if I'm invested in good stocks, I'm staying in those stocks. I'm not selling anything in a market correction because I am getting rewarded even while I wait for the market to recover. In fact, I'm more likely to buy rather than sell anything, right? In fact, buying in some of those lows, you can get some great deals in dividends. I mean, some of the best dividend stocks we've ever seen go on sale every now and again. And typically, it's around things like the 2001 bubble, the 2008 crisis, this COVID 2020 crisis we had last year, right? I mean, I picked up some really sweet deals last year in dividend stocks that have not only increased their dividends in the past year, but some of them have doubled in some cases, right? Which on the capital gains side, that's not a dividend. But I tell you what, when your stocks double, that's a wonderful feeling, right? But hey, you know what? But I made mistakes as well. Last year with the 2020 crisis, um, you know, you just don't know how it's going to go. So I sold a few of my riskier investments. When I say risky, these are still companies with good earnings, a track record, but they're just smaller and I think more prone to capital crises, right? And supply chain disruptions. So I sold some of those, and I actually increased some of the biggest dividend holders I have. So I did well. But I tell you what, selling some of those riskier stocks, it goes against my nature. But at the time, I was reading kind of a doomsday newsletter that scared me out of a couple of my stocks. And being scared out of your stocks is generally not a good idea, right? But the dividend stocks, I can't remember a time where I've really sold a good paying dividend stock, through a time of a market correction. I just don't think it makes any sense. In fact, like I said, I usually just keep adding to my positions.
Yeah, I agree. And one of the things I actually wrote down for this is, along my process, I sort of thought dividend stocks were their own thing, growth stocks were their own things, but some growth stocks end up paying out a dividend. And something that I wrote out here was Apple. Currently Apple's dividend is 0.59%, but you go back a year, you're at 0.76. You go back 5 years, you're at a 3% dividend. You go back 10 years, you're at 6.5. So, I mean, some of the growth stocks now could perhaps pay out a dividend in 10 years. And by then, with the share price appreciation, you could be getting a pretty good dividend back.
I love a dividend growth stock. Of all the dividend paying stocks I have, I pretty much, not exclusively, but largely invest in dividend paying stocks that are growing their dividends. And why do I do that, Joe? There's all kinds of reasons I do that. Okay, a company that pays dividends is typically a fairly stable company, right? I mean, stock prices change by the minute or by the hour. Dividends generally don't. Although you can be disappointed in dividends like we saw last year in 2020, a few companies did stop paying their dividend, reduce the dividend, stop paying the dividend, stop growing the dividend in some cases. But a good dividend growth stock is a really wonderful thing. And I read a book a number of years ago. Actually, I've read a number of books, but that talked about this. But a dividend growth stock over 10, 20, 30, 40 years can do some amazing things. And if you compare it to a bond, I read a book by Peter Lynch back in the mid 90s. Not sure if it was One Up on Wall Street or one of his books. And he made a compelling argument to me about why a dividend paying growth stock makes a lot more sense than buying a bond, you know. Um, and the argument went something like this, if you buy $10,000 worth of a bond, you know what you're going to get, right? You're going to get at the end of 10 years, say it's a 10-year bond yielding 3%. Now, I'm not sure where you're going to find a 3% yielding bond right now, but you probably have to go into the junk territories. But let's say it yields 3%, okay, for hypothetical cases. You're going to, at the end of 10 years, you're going to get your $10,000 back, and you will have accumulated $300 per year of interest payments, right? Fully taxable interest payments. And at the end of the 10 years, you're going to get your $10,000 back. With a good dividend growth stock, okay, you're going to get your $10,000 that you put into it. Let's say the dividend yield starts off at 3% and it's a growth stock. Let's say the dividend's growing by 7% per year. At the end of 10 years, your dividend is now 6% about. And it's, as a company's earnings do well, they tend to grow their dividends and their payouts to the shareholders. And what happens a lot of times is, the stock's capital price is also rewarded. And it wouldn't be outlandish to think that that $10,000 stock is now worth $15,000 or $20,000. So I thought Peter Lynch's analogy was great. And the good news is it doesn't just stop after 10 years. These dividend growth stocks, I've had some for a long time now. You give them 20, 30, 40 years to keep going. And these things, on your initial invested capital, the yield can become quite significant, as well as sharing in all of the capital growth of the stock as well. And, and in some cases, you're going to be disappointed by a stock. Stocks can go to zero, as we all know. But over the long run, if you pick a diversified basket in your portfolio of stocks, you can do very, very well.
I agree. I don't know if there's a better investment in the market than a dividend growth stock because they just reward you on both ends.
Absolutely.
And for me, when I think dividends, like I said, I usually go to energy or financials.
Yep.
But when you think about dividend growth, what sectors would you look
for the person who's starting off, I would typically say what you're saying, starting off in utilities and finances is a really good and safe place to start. In fact, for most new investors, I'd say, why would you start anywhere else? Those are businesses that are very dependable. They're very reliable. They have a great track record. They're not sexy. They're not all that risky. They're pretty, plain Jane type of things, but they are very stable. And I think for anyone who's starting off with investing, that is a good place, a good foundation to build in any portfolio. I know there'll be people that disagree with me. My approach has always been a little bit on the conservative side, and I believe in, really building. It's like the foundation of a house. Build your foundation and portfolio very structurally with some integrity, and then later on in life, you get a little more money, you can take a few more risks, go for some more growth stocks. If you want to do a little bit of trading, knock yourself out if that's your thing, right? But I think always starting off with a conservative base, and of course dividend stocks fit that, the financial ones and the utility ones, very, very well, in my opinion.
Yeah, for sure. And I think that nowadays, most people, what they do is, whatever their number is, the first $10,000 that you invest, they throw into a index fund of some kind, which reinvests the dividends for you, which I agree is also a good method. Keep it safe to build your portfolio initially, and then as you progress and learn more, then maybe 5% you can trade with or invest in riskier stocks.
Yeah, and that brings up a good point. I mean, there is a lot of ways to invest in dividend stocks without owning stocks, the individual stocks, right? I know when my kids were starting off, I would recommend an ETF, right? A low cost ETF. I think costs are a big part of people's returns over the long term, and it doesn't seem too bad when someone says you're paying at 2%, MER, or 2.5%, or in Canada, I mean, we've had MERs at 3%, but those costs tend to eat into your return. It doesn't look too bad in 1 year, but when you start to look at the compounding effect of those fees over 20 and 30 and 40 years, I mean, those 2%, 3% fees, they could they could count for, a third or more of your investment returns. So you really got to be, I think, mindful of that. And the ETFs do a good job of keeping the cost down. When my kids were starting to get into investing, they didn't start off with a lot of money. And I did recommend actually starting off with an ETF. One of them was a financial ETF that's available here in Canada. I think the code was XFN. And it just invested in all the financial sectors, right? So not only the banks, but the insurance companies as well. And it was just a good way of getting some broad diversification for a relatively inexpensive fee until they got enough money to start buying the individual stocks. And then I think generally for most people, it's not hard to go from one of these dividend ETFs, especially this financial one, to investing in the stocks directly, right? When you take a look at the ETF, you can see that probably 80 or 90% of everything in the ETF is probably in 8 or 9 stocks, right? So it's pretty easy to diversify. Once you get a few years on you, a little more savings directly in the stocks. And I'll give you an example. You could own an ETF, a relatively low cost ETF. Let's say it only charges you a 0.5% a year. Hey, 0.5%, no big deal, right? But, um, you know, I've got to pay a fee to buy that ETF, and then I've got this yearly fee of a 0.5%, and that's going to drag the returns down a little bit. I can pay $10 or no dollars nowadays to buy, let's say, $10,000 of a bank stock. I can own that stock for 30 years and not pay a dime in fees, not a dime. So, you can work out the math for yourself, but that 0.5% or 1% fee that they're charging you, it still adds up. And why not turn the odds in your favor and get rid of as many fees as you can, right? As long as you have the propensity and you enjoy doing it, right? I enjoy doing this stuff. That's why I do it, right? I wouldn't do it if it was a drag. And if some people don't enjoy it, then I'd say ETF or mutual fund. You know what? You're better off to just invest through those.
Yeah, especially with like automatic contributions, and then you don't notice the money and you can live on less than you earn
Yeah.
automatically.
Yeah, that that
Um,
that that, that brings up a really great topic, Joe. That one, I mean, investing is one thing, right? But you know, how you live is another, probably a topic for another show, totally, right? But how you live I mean, there is no level of income you can't outspend, right? So just being reasonable in your life, kind of makes this investing thing. It's another side of the investing, I find.
yeah, for sure. We can touch on that, but before we do, I want just one last thing on dividends. I
Yep.
wanted to ask you about. Um, so something that was new to me was with U.S. stocks, there's a withholding tax,
Yes.
and this comes through in your TFSA, which I didn't
Yep.
know,
Yep.
and I didn't know. So, like for example, you buy SPY, which gives you a dividend from American companies.
Yep.
I think it's 15%. You're going to get taxed on that outside of any sheltered accounts other than a TFSA, which still gets a withholding tax. So I don't know if there were any
Correct.
other little things that I should be aware of with dividends, especially US
Oh,
stocks that
there,
you could
there's
think of.
there are so many things, Joe. My son actually called me a few months ago, and he said, "Dad, they're withholding some tax on a stock that I own on the dividend." And I said, "Well, what account is it in, right?" And he said, "Of course, it's in his TFSA." And I talked to him. I said, "Hey, listen, you bought a good stock, right? You didn't understand exactly how that dividend was going to be taxed because it's a U.S. company, but you still made a good decision, right?" So I think finding good investments is the primary goal here. Uh, if it was me, I would tend to hold the stock in an RSP if it was a U.S. stock, or even in my personal, non-registered accounts. Having your TFSA is not a big deal. Probably not the best place to have it, but I still say having a good stock. If you've got all your money in the TFSAs and that U.S. stock is the best stock you think you should buy, hey, I think you go for it. Okay, buy the U.S. stock inside your TFSA, pay the little bit of tax. You know, tax decisions and financial decisions, sometimes they're not compatible. I prefer to make good financial and stock picks and let the taxes kind of fall where they may. But there are a lot of really great things about other good things about dividends that we haven't touched on, right? I'm just going to look at, I mean, a good dividend strategy. Um, you can basically make yourself a little pension plan from that. So let's say you're somebody who has a defined contribution plan at work, or maybe you don't, and you're just saving up money in your TF your RSPs. You know, dividend investing can really play into your hand to make your own little pension plan. Because if you start to pick the right stocks and some different growth stocks over the course of 20 or 30 years or 40 years, which is a typical career, you know what, you can end up creating this cycle of income that rolls in every year that can mimic a pension plan payment, right? Um, Dividends are shockingly tax efficient. And I'm going to throw out a little statistic for you guys. If your only source of income was $50,000 of dividend income in Ontario, how much tax do you think you'd pay, Joe?
I'm gonna guess $0.
You are absolutely correct. Zero to virtually zero, right across our great country, right? So when you take a look at things like that, um, you know, it just gives you another incentive to look at these things. Now, of course, if you're investing in TFSAs and RSPs and that's where all your money is, it isn't that important. But if you're now starting to be in the position where you have more money than you can invest in your RSP, let's say you have a pension plan, so you don't have a lot of RSP room, you can max out your TFSA, and now you're looking for another place to put some money. If you invest that into dividend paying stocks, right, you do get a preferential tax treatment. And not only that, you can share that income with your partner or your spouse, right, which is another, huge bonus. Um, Let me see here. I got a few other things here that I thought I wanted to kind of touch on. So, I wasn't sure if maybe your listeners wanted to know, what dividends are, right? Um, Dividends are a way for a company to reward the shareholders, right? So the companies have a few ways they can do that. So, if they issue their common shares and they choose to pay a dividend, we've got the dividend stocks that we're talking about now, but there's also preferred stocks, right? Preferred dividends that can be paid. There's loans that a company can take out. There's also debt that companies can issue, right? Bonds and so on and so forth. So the common stocks we're talking about are the dividend payers, are the ones where companies have decided, because they're likely stable enough, they're big enough and secure enough, that they have more earnings than they can reuse in the business, right? So some companies, especially startup companies, when they make earnings, hopefully they're making earnings, what they're doing is they're plowing that money right back in the company to try and grow it, right? Or pay off debts that they have, or to do something good for the business so that it can move forward and make greater earnings. At some point, successful companies, they make it to the point where they have more earnings coming in than they know what to do with. So maybe they paid off debt or they don't have excessive debts. You know, uh, they've issued bonds and they've got their bond payments all sorted out. They might have some more money and they say, well, we can't reinvest this. We got more than we need. We've got all the capital program financed. You know what? We're going to reward the shareholders and return some of this money to the shareholders. So what they will do is decide to pay a quarterly dividend. Some pay monthly dividends, and some pay special dividends. It's a nice surprise when one of your stocks, all of a sudden, a bunch of money shows up in your account, and you look into it. You go, "What is a special dividend? Where did it come from? What happened?" It could happen in all kinds of reasons. Sometimes they split off a company, you end up with another stock that you didn't even know existed before. Sometimes you just end up with a bunch of cash in your account, but it's a good problem to have. But let's see here. What else we got? So we talked about the tax efficiency of dividends. It's really, really great. There's all kinds of dates associated with dividend payments, right? So you've got trade dates, settlement dates, ex-dividend dates. That's nice to know about. Me, I don't really worry about that too much. Some people try to game the system by buying a dividend stock at a certain time, and maybe they can buy it before they pay the dividend, just get in before the dividend X date, And I don't do any of that stuff. Some people try to outsmart the system. I say, hey, if you think you can outsmart the system, go for it, you know. But I think you're likely to end up with the disappointment. Something we talked about earlier is the growing dividends. They can really improve your gains, you know. And as dividends grow, it can lead to increased share prices. That's because dividend investors will reward the shareholders of those stocks with ever increasing dividend payments, right? So over, like I said, 10, 20, 30, 40 years, you know, the compound effect of this growth over that time. And it's not someone's brilliance. It's not anything except a little bit of patience and some time, and a good dividend growth stock can really turn out to be one of the best stories that was ever written in your portfolio. And I can attest to that on a number of occasions. But, you know, people can invest in dividend stocks or dividend ETFs or mutual funds. You can do it through your TFSA. You can do it through your RSP. You can do it through your non-registered accounts, right? So anywhere you can make any investment, you can go and buy a good dividend paying stock or mutual fund or ETF. And, you know, one of the best things you could probably do is to just start it now, watch out for your costs, you know, keep it simple. You know, sometimes you get into some complicated things or duplicate stocks and multiple accounts. Try to keep your life simple is some good advice I have for you. And invest for the long term. When you're looking for dividend stocks, I really think what you're trying to look for is you're trying to look for that stock that you want to own for many, many years. You know, um, it's typically not something that you're looking at owning something for 6 months or a year. In my opinion, I've seen the magic of compounding over many years, and I hope to see it for another 30 years, Joe. Okay. And you know, time is your friend when it comes to dividend growth stocks. So just let time and have a little bit of patience work for you. Um, One other thing I think we should touch on is there is a way of investing in these dividend stocks that is called dividend reinvestment plans. Okay, or short for DRIPs is what we call them, right? And it's a really, really I think efficient way of keeping all your capital working for you. So there are a number of companies where you can register directly with the company. So after you own a few shares, you can go and register directly with the company. And what you can do is get into an arrangement with them where every dividend that they pay out, what the company will do automatically is reinvest that dividend payment in equal shares back into the business for you at zero cost. Okay, and in fact, some of these companies actually offer you a discount to buying the stock because you're doing it directly through them. Um, you know, I've only done it once in my career because I prefer to take my dividends and then choose where I'm going to reinvest them or use them. Um, you know, if you're doing this drip stuff in non-taxable accounts, you've got to keep track of your adjusted cost basis of your stock, as every new stock purchases you make affects your adjusted cost basis, right? So that's just something to keep note of. But it's a great way for especially people who are in those accumulation years. Once you found those good stocks you want to keep for 10, 20 years, just keep the money, all the dividends that come from that stock, just plow it right back in. It's a great growth strategy. And you know, sometimes with these dividends, you're collecting $10, $20, $30, $90, $100. And over time, that money plowed back into those stocks can really make a significant difference. And that money, once you reinvest it, it's working for you. Instead of having, you know, maybe $100, $200 or a couple $1,000 sitting in dividends that you haven't reinvested, this kind of does it on autopilot for you, right?
So I've actually enrolled in a drip with
Oh,
Ryocan. They
yeah,
are a big
yep,
real estate company in
yeah.
Canada. And I'd love to hear your perspective on REITs and what you think about them as a way to get some exposure to real estate, because a lot of people like myself, we don't have the capital to go and throw a down payment, especially with houses the way they are now, and get that exposure through direct real estate. So REITs are, I think, a good way of doing that for some of the people just starting out.
Well, I'm going to tell you the truth. REITs aren't my specialty. You know, I've only owned a few of them over the years, so I'm likely going to pass on that. I have a son who's in a bit of real estate by actually buying houses and renting them out. So I mean, I understand the argument of owning a REIT. It's a low PETA factor, right? Pain in the butts. And get some good exposure to some real estate holdings, which I don't think is a bad thing, and it's probably done fairly well for you, I suspect, Joe. Right? I bought one stock. I've had it for about oh, I've it's Brookfield Asset Management. I bought it years ago, made some money, and kind of got away from it for a few years, but I got back into it maybe a year or two ago, and it's about doubled now. But they have a lot of a real estate exposure, and it's done very, very well, and I suspect they're going to continue to do very, very well. And I may even increase my exposure to that. It's been a good story. It is, investing
Yeah,
is
perfect.
it's a lot of fun, right? And I think you've got the bug too. And there's so many resources out there. There's lots of books, lots of stuff online, and if you enjoy it, I think that's the best way to kind of get going on this.
Great. Well, thanks a
Yeah.
lot. Appreciate
Hey,
it.
thanks a lot, Joe. Bye bye.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.